Hey guys, this is Rich Klein from the Diamond Law Group. A very common question nowadays with increasing interest rates is whether or not it's still a good time to purchase or if you should rent. If your alternatives for housing, if you're not going to be purchasing, that means you're going to be renting. And before we determine that, we need to see how much rent is going to be on this website here, which we will share with you. There is a note about the Long Island rental market saying that approximately the rent on Long Island for the average house is $2,000, which is pretty in line with another article, which we'll share with you, that states that from June of this year, the national median rent has hit $2,000 for the first time. So we're going to use that as our alternative to purchasing. So on our rent versus purchase calculator, am I better off renting? Well, first we need to type in the monthly rent. We'll make the renter's insurance share 15 sounds good. Yearly increase, we'll say that it matches inflation, which they say is 2%. All right. So right off the bat, it's saying that without any other criteria, that this calculator is of the opinion that we're better off buying. But let's see as we dive into it. The home purchase, it'd be nice if it was $250,000. We'll go with Long Island is roughly $600,000 is the average purchase price. And let's just put down 20%. The average taxes on our, just some quick research says that the Long Island average is around $11,000. So we'll type that in as well. Maintenance, we'll put it $700, sure. And we're going to stay in the home. This is projected over 30 years. All right. I know that the average is 7, but for our calculations, the determination is going to be for 30 years. All right, because that's the life of the loan. You never know if and when you're going to be moving. So this is as our best case scenario. So again, when you look at this, it still says we're going to buy is going to be better, but we still have some more information to enter here. Again, the term is 30 years. The interest rate, we're going to leave at 5%, and then it has a couple of other closing costs, which again factor into the rental purchase comparison. There's another assumption here that is the key really to all of this. Whenever you're going to determine whether or not purchasing or renting is better for you, you have to take into consideration the fact that whatever you're going to be purchasing is going to be appreciating in value. So they say that the average appreciation is roughly 2% per year. And when you enter that, you could see that the number goes up dramatically because whatever you're paying towards your mortgage, the interest is a tax write-off. That's indicated over here that you're going to be receiving a tax write-off if you file jointly. It increases the standard deduction to $25,000, but between your interest and taxes, even though taxes are capped at $10,000 for the deduction currently, for the most part, the interest and your taxes will usually get you over the standard deduction. So you're going to want to itemize, which is why the tax savings is so huge. So for instance, if you get rid of all of this, you could see that you're not saving as much. So the tax benefit of your bracket is really where the savings comes in. And again, the big put your closing costs, again, taken off the top, because whatever the property is appreciated to, even though we purchased it for $600,000 at 2% compounded for appreciation, whenever you sell the property after 30 years, even paying closing costs at 10%, with all the tax savings that you've benefited from over that time frame, this is how much it would cost to rent, which basically goes towards nothing. You're paying off your landlord's mortgage versus the total cost of purchasing. If you switch over to payments, obviously with all the payments, it's going to be more to purchase. At least initially, And then they have your rent here as just the security deposit, because there's usually no other cost besides your utilities. All right. So just from this real quick comparison, to reiterate, if you have to live somewhere, you have a base cost of renting, which is even at $2,000 per month, even with a slight increase over time, which we entered at 2%. Again, the same increase for appreciation. The appreciation is something that you're going to get back when you sell. If you are purchasing as a joint, let's say married couple, anything that you sell the property for is capital gains free up to $500,000. So that's also taken into consideration with all of this calculation. There's also inflation. So obviously the price of everything's going to go up. So the property itself, besides appreciation, it's going to be more beneficial to you. I hope you found this to be informative. One other quick thing I wanted to show you here is, clients come to me all the time and they say, well, Rich, rates used to be in the 2s. All right. So even a rate at 2%, you're saving so much more money, but rates went up to 5 or 6%. Even if you put this up to 8%, you're still saving money over deciding to rent over 30 years. All right. So again, hope you found this informative. And if you have any other questions, you can reach out to us. Look forward to speaking with you soon. Take care.